Hello, everyone, and welcome back to another episode of the Keeping It Real Estate Show. I'm your co-host, Mike Roeder, and today we're going to dive into the current landscape of commercial real estate. Specifically, we're going to focus on foreclosures being on the rise and lenders seizing distressed properties at levels that we really haven't seen for nearly a decade. And we're also going to explore the most current data and what's in the pipeline for the rest of 2024 and moving into 2025. So as you're about to learn, more distress often leads to more opportunities. So it's a double-edged sword, good on one side, negative on the other. So during the second quarter of 2024, lenders seized distressed commercial properties at the highest rate in nearly a decade, so almost 10 years. Portfolios of foreclosed and seized properties grew by 13% to $20.5 billion, which is actually the highest level that we've seen since 2015. So you might be asking yourself, what's driving this wave of distress? There's really several factors at play. So first off, high interest rates are really driving these foreclosures. And then also the sluggish return of workers to the office buildings are also pushing the commercial property distress towards those near historic levels. And lenders who had previously hoped for a recovery that were really holding on, extending loans, doing loan workouts are now more willing to take over troubled properties because they aren't turning over or making a good leap in the right direction at a quick enough pace. So the data we're going to look at today is delinquency in commercial mortgage-backed securities, or CMBS. And TREP, an industry leader in commercial real estate data, they provide a monthly delinquency report that looks at delinquency rates across different asset types. So industrial, multifamily, office, retail. The CMBS delinquency does not include other types of debt like agency loans, so Freddie Mac, Fannie Mae, but it's still a great lead indicator of trends in the commercial mortgage industry. So we're going to take a look at that. So examining the data from August 2024, we saw overall US CMBS delinquency rates increase to 5.44%. which is an increase of about 1 basis point for the month. 1 year ago, the US CMBS delinquency rate was at 4.25%. And then 6 months ago, it was at 4.71%. So we've seen an uptick of about 119 basis points over the last 12 months. And that's a serious uptick. If we also count loans that are past their maturity date, but still current on interest payments, so that means that there's been some sort of loan workout most likely, the overall delinquency rate jumps to 7.21%, up 43 basis points from July. 43 basis points in 1 month. This large difference between these two figures suggests that many property owners are negotiating with their lenders to extend loan terms because they can't make their balloon payments due to current market conditions. So that's telling us that these property owners are underwater. They're not able to sell and get the funds back to themselves or their investors. They would take a loss. And so they're doing these workouts with the lenders and basically pushing the can down the road. And instead of paying off the loan or selling at a loss now, they're opting to kick the can down the road by extending the loan, hoping for better conditions in the future. Now, this month, the uptick in overall US CMBS delinquency was largely driven by a 67 basis point increase in multifamily delinquency, which went up to 3.3%. And keep in mind, this is the highest level the multifamily rate has climbed in more than 3 years. The last time the rate even eclipsed the 3% mark was back in July of 2021. And for context, there was a large multifamily loan that accounted for north of 54% of the property type's newly delinquent total. And this was a portfolio loan that had previously been current on payments, but now it's showing a delinquency status of non-performing matured balloons. So that does skew the data there a bit. Meanwhile, the office delinquency rates are much higher at 7.88%. And that's what we're hearing in the market, is that office continues to really struggle because a lot of these buildings have a very high vacancy rate. You also have a lot of shadow inventory. So you have long-term leases that are in place where these buildings are vacant, but they're still paying rent. And those leases are coming due, and these properties are starting to become more and more delinquent. For experienced operators, these distressed properties can really present a significant buying opportunity because you're getting the properties at a discounted price, a heavily discounted price. Now, while distress may persist, this environment can be ripe for those ready to capitalize on potential deals. Now, There have been some notable foreclosure cases recently. For example, KKR Real Estate Finance Trust seized a 5-building complex in Silicon Valley, and KKR is a huge private equity firm. They seized this from Goldman Sachs Venture. In another case, State Farm Life Insurance foreclosed on an office building near the White House, which later sold at a 70% discount. So this is showing you that a lot of the big dogs are getting back into the game. And then also you're seeing some massive discounts out there as well, which is good for the buy side, bad for the sell side. Smaller banks are also increasing their foreclosure activities. In the first quarter of 2024, small banks, so basically banks with assets under $10 billion, saw a $125 million rise in seized commercial properties, marking the largest quarterly increase since the year 2000. So that's starting to creep up as well with the small banks. And how does this compare to the 2008-2009 financial crisis? I'm sure a lot of you are asking that. Now, while foreclosures today are still below the levels seen back then, there's really a notable difference in owner behavior. Many more investors are willing to walk away from their properties, and this is leading to an 83% increase in lender-participated sales in the first half of 2024. Again, for investors, these distressed properties can present significant buying opportunities because you're seeing the pricing being significantly off from their highs a couple of years ago. And while some risks from commercial properties may persist, this environment can be ripe for those ready to capitalize on potential deals if they're in the right position and they have the right team and they're in the right market to reposition the asset and create that value as they go and reposition the deal. So it's really about careful strategy. It's about the right moves to create a significant amount of value in this commercial real estate downturn. So thanks so much for tuning in to another episode of the Keeping It Real Estate Show. We hope this episode brought you some value. If you enjoyed today's episode, please leave us a rating and review. Share it with someone you know. It really helps us bring on great guests and deliver great, valuable content. Have a fantastic week and go out there and create some success.